will come back to help her dad. Taxes can be a significant expense, but legal strategies exist to reduce your tax liability. This guide covers key areas to explore potential tax savings. However, remember to consult a tax professional for personalized advice. Maximize retirement contributions. Consider 401(k)s with employee contribution limits of $19,000 if you're under 50 or $25,000 if you're 50 or older in 2019. These reduce your taxable income, and you should aim to maximize employer matching for the greatest benefit. You could also use a traditional IRA, which may be tax-deductible depending on your income and retirement plan coverage, with contribution limits of $6,000 if under 50 or $7,000 if 50 or older in 2019. Don't forget about a health savings account, or HSA, which offers tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Contribution limits are $3,500 for individuals, $7,000 for families, with a $1,000 catch-up for those 55 and older. Itemizing deductions strategically can also save you money. You can deduct medical expenses exceeding 7.5% of your adjusted gross income, including doctor visits, hospital stays, and qualified long-term care expenses. Be aware that state and local taxes, or SALT, are limited to $10,000 per household and include state income or sales tax and property taxes. Mortgage interest is deductible on mortgage debt up to $750,000 or $375,000 if married filing separately. You can also deduct charitable contributions to qualified organizations, keeping detailed records of both cash and non-cash donations, but these are subject to adjusted gross income limits. Consider bunching deductions, paying deductible expenses in 1 year if possible to exceed the standard deduction. Capital gains and losses also play a role. Tax loss harvesting involves selling losing investments to offset capital gains, and you can deduct up to $3,000 in capital losses against ordinary income, or $1,500 if married filing separately. Just be mindful of the wash sale rule. Long-term capital gains rates are typically lower than ordinary income tax rates, and holding investments for over 1 year qualifies them. Qualified dividends are also taxed at long-term capital gains rates. Other way to save is to take advantage of tax credits, such as the child tax credit, which is up to $2,000 per qualifying child with a refundable portion up to $1,400, but income limits apply. There's also the Child and Dependent Care Credit for expenses related to child care enabling work or job search, where the credit amount depends on expenses and income. You might also qualify for education credits, like the American Opportunity Credit or the Lifetime Learning Credit for qualified education expenses, but be aware that specific eligibility requirements apply. Finally, the Earned Income Tax Credit, or EITC, is for low to moderate income individuals and families, and the credit amount is determined by income and family size. Our business owners and self-employed individuals, there are specific opportunities such as the Qualified Business Income, or QBI, deduction, where you can deduct up to 20% of qualified business income, with limitations based on income. The home office deduction is available for using part of your home exclusively and regularly for business, and you can calculate the deduction based on square footage. You could also deduct 1/2 of self-employment tax from gross income. Consider retirement savings options like a SEP IRA or solo 401(k), which offer higher contribution limits than traditional IRAs. Planning is crucial for financial well-being, so understand available deductions and credits. Consult with a qualified tax professional to optimize your tax strategy for 2019 and beyond, and remember to start planning early. Thanks for watching. See you next time on Helper Dad.